think, act, and prosper. You are now tuned into the Money Level Show.
Hey everyone, welcome back to Money Level Show. We're welcoming back Alan Galecki. How you doing?
Hey Daryl, thanks for having me. I'm doing fine. And how are you?
Oh, doing well, doing well. Just been learning a new art. You know, you and I we talked off camera last time about valuations. I went and picked up some books. I still have to, kind of plow through, but I got the
Oh,
capital
great.
return. I
Very
got
good stuff.
financial
Oh,
shenanigans here.
fine, nice.
I'm getting through capital returns now. I have not started financial shenanigans, and then I also have this behemoth of a book right here. So yeah, so
I
I'm
have it.
definitely got my home
Uh,
laid out for me.
yeah, I have it also on my shelf,
Go,
but haven't opened it yet. The last one. But Capital
yeah,
Returns is one of the best books I've ever read, and I hope you can confirm that after you're through.
yes. It's been really good learning about the capital cycles and how money rotates in and out of sectors. Because ultimately, what I've learned, because even just getting into technical trading as well, just how you know the 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 retail investors are following the big money, and the big money trades off
Correct.
specific rules and stuff. And so, like, when you look at capital returns and capital cycles and things like that, it all intertwines together. Because I used to think retail would move the market, but it has to be a very, very um, small sector or small market caps for stocks to really move significantly. And I'm thinking like specifically, about uranium back in 2021. There wasn't a lot of institutional investing then and such, and then we had some huge price spikes, and I think that was mostly driven by retail. And so now, we've saw more institutional investing come in and stuff. And I mean, we'll get into updates on uranium and whatnot. But yeah, so I got my homework laid out for me and everything. So I appreciate you taking the time to interview me for your newsletter and everything.
You're welcome.
Yeah. So I want to jump into Nike. I want to jump into Nike. Let's start there. So Nike got had a huge sell-off, and I had remembered you had posted about it on Twitter. I had put it in the interview to your newsletter subscribers, not as a um, investment, even though I love Nikes. Like, I have a lot of Nikes in my house. Um, I didn't have a full conviction on terms of like the company itself. Like, okay, is it fairly valued or not? And so I was glad to see you actually go and look at the company. And then, but I was looking at it from more of a technical standpoint.
Mhm.
And so I want to jump over there. I'm just right now. I'm just uh, pulling up the charts, and I want to show what I was looking at when I had referred to Nike. So I'm gonna go ahead and share screen here. All right, here we
Okay.
go. All right, so as we can see, just looking at the weekly chart, we saw Nike fall off the cliff here, off the news from I think it was like their forward projections and such. And this was just a um, huge gap down. I mean, if you look at it on the daily chart, you just see like just a gap off, like just falling
Oh,
down.
yeah, absolutely.
And And so, like, normally, even when I see these types of things in stocks, what I've noticed is that you usually get some type of dead cat bounce or some type of um, recovery. But even if it may not recover to its previous highs, you usually get some type of recovery. And so that's what I was trading. And then these zones here, these are like larger zones on the weekly, but that's what I drew them on. But as I was looking at this, I was looking at the just kind of the levels, psychological levels here. I mean, because when it dropped down here, I couldn't find anything to even match this because the price hasn't been this low since until 2020 crash and before 2018. So it hasn't been
Hmm.
this significantly hit these levels in a long time. And then I was looking at this level here, as you can see, it touched this level here. It bounced off this level here as well. And so here we're getting back into that resistance zone over here between 82 and 88. And then if it were to even break out of this, I mean, this is the next zone that I have as resistance and support. But this was what I was playing when I had mentioned this to your subscribers that I
Yeah,
was
no,
in,
no. Mm.
and I was waiting on that, and I freaking sold it before it bounced. So yeah, shame on me. I was in it. I was in it. I didn't play my cards well. But I wanted to talk through your assessment of Nike, and this is just and you all, everyone that's watching, this is just technical uh, pieces. This has nothing to do with valuations or anything like that. This is more market psychology and technical levels and such. And so I wanted to get your take on Nike and what you saw when you pulled the company up.
Yeah, first a remark on selling too early. There in this field, I'm an expert too. I had split adjusted Tesla bought at 15, sold at 30, and we know what happened afterwards. But this is a way older story. Regarding Nike, I'm not a chartist expert, and I'm not spending too much time on this stuff. The only thing I'm doing is I'm from bird's eye view, bottom to top down view. I'm when I see dramatic run ups and or later also collapses of the stock price, I know that something dramatic has happened in the company in the underlying business. And if I'm seeing charts like these, I'm starting to look in a ticker in a database what has happened to Nike. And when I published my article, I saw that their growth has come down to a 10-year low and that their results were very weak. So in the end, to distill it, charts or prices of stocks sooner or later always follow to what has happened in the underlying business. And this is exactly the case here also. And we know that investing is about expectations. You mentioned psychology. This also plays a big role. There's sentiment inside of such trades. And I personally don't know whether there are these resistance levels and this stuff is that much important. I cannot confirm that because I'm not acting based on such things. But what I can say for sure is the big drawdown was due to Nike giving a very weak guidance for this current year. Their fiscal year ends in May. It's a bit off the path. It's not according to the calendar year. And they are the former growth story has come down tremendously. And for this year, they are not sure whether they will be able to even keep the same sales level they had before. And this is in so far important as the stock has always been valued at a high premium. I know we weren't about to talk about valuations at this point, but when you have, but this is somewhat interconnected, when you have absurdly high valuations, you have high expectations, you have high or positive sentiment, and often hot run-ups before. And if something breaks in this blue sky scenario, then of course the chart which previously looked pretty great until 21 or 22. It was a very nice bull story. The stock knew only one direction, that was up. It ran from all-time high to all-time high, no matter the valuation. And at the top, it was valued about a 50 PE. And this, of course, implies very, very high growth expectations. However, we know that Nike is mostly a saturated or matured company, let's call it this way. Of course, they had some hopes regarding Asia and China in particular. However, their economy has turned down massively too. And so many companies, not only Nike, but also Starbucks, or we had luxury companies and car manufacturers that were heavy on China, Porsche or Mercedes from Germany. They have all had to dial down massively on their expectations, on their growth forecast, and this is what has happened to their stocks. Then they have fallen massively from the highs, not seldom even by 30, 40 or 50% or even more. And I'm not even sure that this has been all until here.
Yeah. Yeah, definitely. And even when I bring up the charts, this is more of a short term, investor outlook, and there's different styles of investing. I mean, that's more trading, in terms of like, oh, I'm
Yeah,
looking
sure.
at the stock to go up, like it was oversold, expected to go up to at some point, sell, take profits, but you're not holding this stock for like, 5 years or anything like that. And so you're coming with the knowledge that are like, okay, maybe this is something we can hold for a year or 2 years or 3 years and such. And so like you're coming with the more long-term knowledge. And so that's why I think it's good just to like, even just look at the short term and long term so that people really understand that outlook, and so that they can they can invest accordingly. When you had mentioned Starbucks as well, which I know you had did like a tweet about it, and you mentioned Starbucks valuations and such, and Starbucks was just getting clobbered, right? I mean, it was significantly high. This was 2021, all the money printing and everything. Um,
Mhm.
it sells off, interest rates rise, then it starts, rising again into the middle of last year. And then it just goes on a sell off, and you see this huge down week here.
Yes.
Yeah, and then, so like that was back in April. And then, sometimes it's like it's interesting, like when you look at valuations, because it's almost like the stocks are like a house of cards, because you get some bad data that comes out about the forward outlooks or their profitability or something, and you just get these huge falls off the cliff, right? And so we saw that with Nike. They put out their information, and when they had their earnings report, and you see the fall off the cliff. Starbucks, I think this may have been the last time they had earnings too. You see this huge fall off the
Mhm.
cliff. So like, and that's like the importance of like valuations, because then when you see these bad numbers and you see these economic conditions that are happening, that are impacting the company, and you can begin to see like, okay, this is why it's like a house of cards. Obviously, we see this huge candle here. For those that don't know, Starbucks ended up hiring Chipotle CEO, and Chipotle stock has been like freaking was on a tear for a while. Let's look up Chipotle. I mean, that was like one of the hot stocks for a long time. They did a stock split. I mean, as you can see, I mean, from
Mhm.
2023, I mean, from 36 to 69, and it was actually, I think it was in the hundreds of dollars before they did the split. But you had this news come out about Starbucks hiring their CEO, and then you begin to
Yes,
see
correct.
fall off the cliff too. So it's kind of like a house of cards in some of these companies. It's interesting, when you look at it from a investor standpoint. It's like, okay, dude, is this a company you want to hold for 5 years, and why? Why would you want to hold this company for 5 years if you're seeing that they aren't as profitable, or whatever's happening with their business model, or economic factors that surround it. But then obviously you get these other random news catalysts that, someone holding Chipotle stock thinking that, oh, Chipotle is going to go back to all-time highs, and then you see the CEO gone. I mean, and it cratered, but yeah, it's kind of interesting just looking at those dynamics.
Yes, I would like to comment on the topic of valuations and also expectations, again, using these two cases. The CEO change has been an event unforeseeable for us. Of course, one could have suspected that Starbucks sooner or later will have a change, but no one would have predicted that exactly this situation will happen, that a successful CEO from Chipotle comes over to Starbucks, and these two stocks behave like they did. And valuation is in so far important because it is an indicator of expectation, and also it can tell you something about whether there is a margin of safety implied into the stock or not. This means if you have a successful company, expectations are usually linear, that the current trend will continue as is or even become better, resulting in at times absurdly high multiples, leaving no room for error. This is what I mean by saying margin of safety. And the smallest disappointment or any unforeseen event, this can be a CEO change like here, it can be announced merger we didn't know will happen, or taking on debt, maybe not regarding these two companies, but in other cases. And you can look at charts, you can look at financials. You don't know that such things happen, and you don't know when they happen. And these events take investors and participants by surprise, sometimes catch them off guard. And this is why such big swings happen. And sometimes they are already erased within a single day. The initial reaction is often an overreaction, and this is brutally high to anticipate and to act to such events, and the more so before anything like this can happen. And that's why having a buffer room to maneuver a bit to be on the safer side is so important. The risk, of course, is to miss on such trends, on such turnarounds. Of course, Starbucks hasn't been looking very well before the CEO change was announced. I was bearish about it. I'm still bearish about it, but now I'm looking like a fool because the stock of Starbucks, of course, has jumped meaningfully. However, this has not changed anything based on the fundamental situation that we have a weakening economy. And the CEO now has to deliver. Maybe he will turn the ship around. I don't know. We'll have to see. However, when investing and looking at stocks and all the big tickets, the deep-pocketed guys, professionals, they all do the same. They always focus on risk first and not on what could be the potential reward. What are the chances? Could I 5x or 10x my money over the next year? This is the wrong approach. It is way too risky because often this is not successful, and that's why focusing on risk, on valuations, and on always questioning oneself what is already priced into a stock, and what are the current expectations. And if you observe stocks over the long run, you will always have very rare occasions where sentiment is very bad because either the there was a company-specific event that has driven the stock down, or in general, the sector has performed weak. If it was a more cyclical one, you will have rare but very high, low risk and high reward situation where you can then join the stock for the long run. And these are not points I'm currently seeing at all of those names we have looked currently at.
Mm-hmm. Yeah, and that's important, and before we segue, because you mentioned a very important point about how information changes, data changes, and there's unexpected things that happens, and so like for example, you mentioned we were talking offline about the election in Mexico, and so
Mhm.
I do want to here in a second. I just want to look at Zoom really quick, and I do want to
Yeah.
highlight like because you've been talking about Zoom for a while, and Zoom is actually holding up fairly strong. And this is like where you get into like some real valuation. So when I'm looking at Zoom on a technical basis, I mean it's been just chopping sideways for a long time. And this is on the weekly chart. And so if I look at the daily, it's been pretty
Yeah, in the
sideways.
long run, it actually looks like a dead company. This is where we begin, and because or why many people are afraid to even look at this one. No? But you have to understand that the company has gone through a tremendous change, and this is why it has become interesting as of late. But
Yeah.
sorry for interrupting there.
No, you're good. You're good. Yeah, and so like, to your point, when I'm looking at the charts, I'm looking at this is an indicator called the TTM squeeze. It just shows like when there's buying
Okay.
pressure, and it's been in this sideways chop for a long time. And I wouldn't be surprised. I mean, even looking at the exponential moving average difference here, the selling pressure looks to be dying down. Like I wouldn't be surprised to see a pop in Zoom, in the next, I think they have earnings coming up soon and stuff. They've been crushing earnings on
Yeah, next week or so, or 2 weeks,
yeah. So
something like that. Mm.
yeah, so they've been crushing earnings. Like when I'm looking at their earnings report, they're beating expectations every time. And so I wouldn't be surprised to see this pop. But when you're looking at, like you've been mentioning Zoom for a while, like even when we had the huge sell-off back in on August 5th, right? I mean, Zoom, it took a little bit of a dive, but it's still relatively within this same range that it's been chopping in. And so versus like when you look at some of the other charts of companies where they sold off significantly. And so this kind of I feel like that says something, about the valuation of Zoom because like even when everything was selling off, it didn't really get impacted as much.
Yeah, sure. It's a tech company, and despite being in this sector, it has barely moved, we can say, over the last quarter or so. Of course, there are swings up and down. However, the bottom line is barely anything has happened. And this is an indicator for me that retail has clearly lost interest in this stock. And this is a good sign because retail usually comes late to the party and jumps late on already matured trends. No? And maybe it is helpful to imagine, maybe let's do a thought experiment. Zoom weren't a publicly listed company, but private. And I tell you that I found a company that has that is a high margin, that is a market leader, that has been challenged by competitors. However, it has been able to keep its position very high. The market share is roughly 50% against really gigantic tech behemoths, which is incredible to achieve and to not only temporarily, but over many years until here. Growth has come down, of course, and this is why the stock has crashed, because they have previously been able to double and triple sales and earned incredible money, and sales growth has come down to basically yeah, low single digits. This is the case now. Expectations are very low. However, as I said, very profitable, and of course this doesn't work in a privately held company, but they are buying back shares now at these low valuations. At the top, somewhere around 300 something, they interestingly did a capital raise, which is also a very counterintuitive, however, very powerful and shareholder friendly move, because dilution was very minimal. Most companies are doing capital raises at the bottom and buying back shares at the top, and this one is doing this stuff exactly the opposite, or the other way around, very shareholder value creative. And when you don't expect anything, the company is stable, has a stable customer base, and is currently switching more to enterprise customers from more fragile retail users. And on top, they are also expanding their offerings. It's not only communicating and recording videos, discussions like we are currently doing, but they are also offering to record and transcript and summarize discussions via their AI tool. I'm sure this is something many will be happy to use in the future, where you don't have to sit in conferences writing per hand on paper and summarize what some people are saying, when a tool can do it for you. And they also have a teleconferencing solution for call centers. So what has been a one-trick pony has become a more diversified offering, very interesting. And the key here is, as I said, that no one is expecting anything. So basically, not very much can go wrong. Of course, if the company suddenly loses very tremendously in market share, and either existing competitors or a sudden new offering emerges that has way better features, and it crushes Zoom, of course, in this case will be altered, and we will then close it. But until here, 1/3 of the market cap, or 40% in the meantime, is pure net cash they have on the balance sheet. So effectively, the valuation is 40% lower than when you are looking at simple PE ratios, because they don't take into account the balance sheet situation. And I know it seems quite boring. It's not this hot stuff AI that everyone's talking about. It's not making headlines. But I feel very comfortable with such situations, because when everybody were talking about it, the likelihood of it being overvalued would be quite high, like it was the case when we had 2020, 21.
Mm-hmm. Yeah. I mean, just looking at the stock price, it was close to $500 at one point.
Yeah, incredible.
And
100
you know,
times
it just
sales or so.
just thinking about that, like, you know, and this, even the price that it's at now, you can see that there wasn't a lot of dilution or splitting or anything of that nature. Like Zoom was actually at $500. A lot of times when you see some of these companies that dilute and stuff, you see like the share price was a certain, like $100,000 or something. You're like, this could have been no $100,000. It's like, oh yeah, they diluted the heck out of it, you know. And so
Oh yeah,
yeah, one was actually at $500. And so that's
mining companies, biotech companies. Yeah, sure.
yeah, for sure. So yeah, uh, I appreciate that. I mean, and this is like something that's primed for a move. This is something that you could sit in and actually hold, because you're like, okay, there's a lot more strong, strong finances around the company. There's a lot more. I mean, you're not seeing like the overhyped pricing where people are just running up prices and you get these huge fluctuations and such. And so it's something that you can hold and I'm sure at some point it's going to get on the radar and it will eventually take off again. I'm sure. Well, I can't say that with certainty, but I mean, that's what it looks like to me. I mean, especially, it being a solid company. I mean, we're using Zoom right now. I mean, people still use Zoom and, yeah. And so I think that, with the cheap prices it is at now, it continues to beat earnings and such. And, I think at some point people are going to start looking at it. Institutions are going to start looking at it.
Yeah, the main bear thesis was that when working from home or remote disappears and people will start to go to the office again, then they will stop using Zoom. But this has proven to be absolute nonsense. It is completely irrelevant whether you are completely at home or whether you are 4 days in office and 1 day at home or whatever mix you pick. Companies are forced to either use Zoom or one of the competitive offerings simply due to the fact because otherwise you cannot bring all people to the table at the same time, and the more so if you have an international organization that is operating in many different time zones. It is almost impossible to not use such tools anymore in our modern
Yeah.
setup we have.
It's like they didn't factor in like the human psychology of it. Like, you gave a lot of people a dose of work from home, and people are like, yeah, I don't want to go back in the office, like especially full time, especially
Sure.
if I can just meet with you via Zoom, and I mean, even for me, I work hybrid, I work
Mhm.
I'm at home, half time at my job, but we use Microsoft, but the same concept applies of just like, yeah, like people aren't working full time unless you're doing a lot of blue collar work, where you engineering or such where you have to be well, maybe not necessarily engineering, but at least like, these physical trades, where you have to be on site.
Sure.
Um,
Which are being sent offshore either way.
yeah, for sure. So you mentioned earlier, you mentioned Mexico, and
Mhm.
yeah, we were talking off camera about Petrobras and oil, and then we talked a little bit about uranium. So has anything changed in your thesis on these particular assets, or what are you doing now in terms of natural resources?
Oh yeah, absolutely. Thanks for asking, Daryl, because this is a very important topic. I would give it the headline, one has to be an adaptive investor. This means although we are investing for the long term, mostly, we have to monitor what is happening around us. And sometimes this leads to situations where your thesis, which formerly was very firm, you had high conviction, and the risk and reward was clearly in your favor. Suddenly, you at the point start to realize, okay, there are some cracks emerging, and the thesis is not as strong as it was before. This can be due to the valuation not being good enough. However, it can also be, of course, due to external factors. You mentioned the election in Mexico or the situation in Brazil surrounding Petrobras. Of course, this is not something new that has emerged overnight. However, it has led me to not feel highly convinced anymore. And this is, for example, why I have closed the case of Petrobras, despite being bullish or neutral bullish on oil. From the commodities sector regarding silver, I had Silvercrest, a Canadian mining company that has a single project in Mexico, however, a very profitable one with an excellent management team that in the past had a successful project with a similar name. It has sold it for a huge premium to a competitor, and this is a similar playbook here in this case. However, despite having very clean financials, being debt-free, having net cash, having high margins on its project, there's nothing on the company level I can criticize. I closed this case simply because in Mexico there is a new government and who is very anti-mining, and this has added another risk pillar to the thesis. I do not feel comfortable with enough because this company has only this one project. It is not diversified geographically, and it has become somewhat of a bonk game where you can basically flip a coin. Will nothing happen? Fine, the company will earn incredible free cash flows and either buy back stock or do a merger later, which they intend to do, or some taxes will be raised dramatically, or there will be any other limitations coming from the government interfering into their operations, which we cannot influence and foresee. That's why I decided to toss this case and say no, the risk is too high. There are too many potential things outside of hands of the management of the company, which they had run pretty well until here. Cannot influence it. I'm out. Thank you. It was fun, but not anymore. And other resource cases, in one of our first interviews where we have done an outlook for 24, you asked me, Daryl, which sectors and companies I'm very optimistic about and where I could imagine that they will perform very well in 24. I answered uranium and met coal. However, I must confess that I have become not optimistic anymore about met coal, simply because it is correlated with steel, and steel is crashing due to worldwide economic activity slowing down massively. Of course, not everywhere at the same pace. However, on average, it has come down despite some single markets like India still booming. However, they cannot balance what others are losing. As met coal is dependent on steel, I have closed this case. Also, I had Arch Resources open. The bottom line for my members was it was very slightly positive when I closed it, factoring in dividends. It was not a loss. However, the risks here have also increased dramatically. And since I closed this case, the stock is down by roughly 12% or something like this. And I looked again at valuations here. I've seen it is trading at 2 times tangible book value, implying a rather fair valuation, and definitely not an extreme undervaluation you need to have for such cases when the economy is turning against you. Usually at the trough, when everything looks pretty pessimistic, these companies are trading below book value. So we can say, as a rule of thumb, roughly that downside of 50% cannot be excluded anymore if the current situation persists or even turns worse. So risk and reward has shifted from good, it was how it was previously, still at the beginning of the year, to not favorable and risky. So that's why I had to pull the plug at this point. Of course, I continue to watch it because I'm convinced that coal making steel will be needed over the long run. However, I do not want to experience a 30 or 50% drawdown, which would be very painful. And the other thing, uranium, I'm still bullish about uranium. This is okay. However, I have underestimated a bit the retail frenzy that has occurred when uranium has crossed $100 and everyone was talking about 200, 300, 400 and so forth. This is the playbook we have always a trend. When uranium was at 2030, this was the first time I was looking at uranium, and also before I even had my blog, I was already investing in uranium, but it was about around $30. I have sent out my report about yellow cake to my readers when it was slightly below 50, and they're still, despite having roughly tripled from the bottom, no one was talking about uranium, with the exception of pros and people who are really interested in this stuff, but the average Joe definitely was not. Then 60, 70, 80, the year 22, 23 were very great years for uranium. And towards the end of the last upcycle, or the last part of the upcycle, investor sentiment has become too good, and the price has come down since then towards the lower 80s, where it is hovering around since few weeks or even months. And I think that here we have a decent chance that this is a bottom. First, because sentiment has turned really bearish again, or at least I do not read anything positive from voices I've seen before. Not every second Twitter post is about uranium anymore. This is also a good sign. And also the spot price is currently has reached a level where the contracting and long-term deal making between producers and utilities is taking place. So again, we have of course, there's no guarantee. We can be caught off guard and surprised. There can be a nuclear accident, and then of course the thesis is completely void. However, under relatively normal circumstances, the risk and reward has shifted again from from semi-favorable, I would say, to rather more optimistic, because the utilities will need to buy uranium, and in the end they won't care whether they will pay 80 per pound, 100, 120 or 150 per pound, because their main task is to keep the lights on and to keep things running, and the biggest cost is constructing these plants and not running them. So in the end, I think we had a necessary clean out here in uranium. And if we look at, because we were looking at charts previously, if you could pull out a uranium chart, Daryl, over the last 5 years, we have seen already 3 or 4 such seemingly painful corrections. It was not a run up from $15 to 100 in a straight line, but they were always 30, 40, 50% up, then 20% down, then the same up, then down again and up again. And this is absolutely normal behavior. At times, markets are overheating, then we need a pause. Either they go sideways, or in this case, in commodities, it's often what looks like a crash. It's only a temporary cleanup and wash up to shake out weak hands, and then the underlying long-term trend resumes. And how can you gain confidence that the trend is not over and you should continue to be in the seat is you have to understand the big picture, which in uranium is basically that supply is increasing. Many mining projects have either started to dig out more uranium from the ground, or they announced investments and restarts of their previously idled projects. However, most of them, or many of them, will take time. This cannot happen over a weekend. When they announced it, even when Cameco had idled its big mine, it took them a year, or slightly a bit more than a year, to turn the lights on again. And it's not only about restarting somehow, but to reach full capacity again. This is also another question. And in the end, bottom line here for me is the overall situation hasn't changed. We are seeing utilities being in a situation to restock in the US even more than in Europe. However, the more time passes, the more utilities will have to come back to the market to replenish their inventories with uranium. And it is also not excluded that one or the other will buy even more, because uranium has the special setup that it is safe baseload energy, and safety and reliability is the what counts in the end. You do not want to make the biggest bargain when being in the sector. You want to be the most reliable party. So in the end, even without any supply disruptions coming from Kazakhstan or from this processing that happens mostly in Russia and is exported to the Western world, which is another risk factor. Enrichment, correct. This is the word I was seeking. Thank you, Daryl. This is another risk factor that is absolutely not factored into this price. It is, you could say, a bull thesis on top, and so there's very little that speaks against this trend at a point to find its direction way back up. So it's we can sit there, watch it, have patience, and don't pay too much attention to day-to-day noise. We know the underlying big picture is absolutely intact. So risk is minimal at this point. It's not zero, but minimal, and upside is still there. And this is a favorable setup. I like. I continue to be in here. So another point to close this, it's more or less independent of what the economy does. This is also a big plus. It does not matter whether one or the other factory closes or whether people quit to sit in the office, but instead sit at home. Electricity is needed regardless of the economy. So in the end, they will continue to produce electricity, and they will continue to need uranium to keep things running. This is the thesis, and I'm absolutely comfortable with it.
Yeah. That's some good points. I want to add to that. So I was looking at the last point of resistance, and obviously here it was just falling down after that huge run up.
Yeah.
But you had reached some resistance here at $72 and some change in that zone, and then you can see here when we zoom in here, there was a little bit of resistance here at $72, which was back at that old level back in 2009, 2010. And so I view this as support, but obviously we're looking at a commodity, so you got to treat it different. This isn't this isn't a stock. But just looking at here, it's holding up fairly well. I actually went in and I've been talking to some friends of mine about the recent sell-off in some of the uranium equities. So if we look at like Cameco, for example. Cameco fell off. I had Cameco back at $12. I didn't know what I had in my hand. I sold it for like $8, and then it goes up to 56 later on. So this was just I had it back here when I was just learning this stuff. And so it went up to $50, but it wasn't a straight move. These are some violent moves that can happen in this particular sector. But as we can see, at just a few months ago in May, Cameco was at June was at an all-time high. Well, not an all-time high. I can't say all-time high, maybe, but it was at over $55, and then he had a huge sell off. It sold off to about 35 when the rest of the market was selling off. So people dumped their shares and stuff. So I went in and actually started accumulating. So I was able to catch some of this bounce here, but
Mhm.
I felt this was my opportunity to get back into some of these because I did not want to buy them at the $55 level. So, just being able to keep in touch and watch like what's happening with the moves in the market can give you some good entry points. Um, and even same thing with URNM, the ETF for Sprott.
Mhm.
I had a big sell off as well, and I was able to scoop some up here around this range and then catch that bounce. But I'm looking at holding longer term. I just bought like one small tranche, and if it goes lower, then I'll buy some more. But I think that getting in at these prices, is better than getting in at the top.
Yeah, absolutely. You've done almost everything right, with the exception of selling Cameco too early. But this was part of the learning process. Everyone from time to time has a stock where you sell too early. In the end, you have to refocus on the future and not to remain in the past. And this is what you've done absolutely correctly, Daryl. You assess the situation also right at the top. Buying was not very favorable when we had a panic here at the same time when we had the Japan crash. However, uh, physical uranium has almost nothing to do with Japan, as we had the situation. So I think well done, and sitting patiently on this will be the way to go.
I just want to look at utilities really quick. This is the XLU. It's a utility ETF. But as the market was, I mean, utilities have been just ripping. I mean, since
Mhm.
late last year, it's been just on the uptrend. I mean, you got higher highs, I mean, higher lows here, higher lows here,
Yes.
and so you're seeing that utilities are ripping in the midst of like chaos, and they're staying strong. And so when you look at utilities and just like how you mentioned earlier, like people are still going to need electricity. People are still going to want to turn the lights on in their home and stuff. And so they're going to need utility companies are going to need uranium and things of that nature. And that's a lot different than oil. I mean, obviously, oil, helps make the world go round. But we know that when there's like job losses and stuff, it can impact the price of oil. But if you lose your job, you're at home with the lights on and you're on Netflix or something, right? And so and so
Yes,
utilities are still
even
gonna.
this requires electricity.
Yeah, yes, exactly. So yeah, so I wanted to add that to the point that you were making with uranium, the physical uranium still staying relatively strong, and you can see that here with utilities as well.
What will kill this market in the end? This is a question often asked. Is not if uh, these stocks will be driven up too much or something like that. One has to look at the supply situation, and when the market gets oversupplied at a point, then this will turn prices of your spot uranium down, and then this will be the situation when this market will finally have seen its heydays. However, this can be well into the next decade because, as I said, projects being it restarts or even completely new projects that haven't mined anything before, it takes years, and often they are accompanied by delays, by cost overruns, by financing questions, everything not easy to solve. And in the end, we have to watch. We can say relatively for sure that demand will go up. We don't know by how much. but the deciding factor will definitely be supply. And when many new names start to emerge we haven't heard of before, new mines, new jurisdictions that were previously unprofitable to mine will come online, then it will be time to get cautious. But this is definitely not the case now. And so this is, I would even say, despite being highly cyclical and a commodity, this is one of the more defensive investments in the current environment we have, given that you can stomach a bit of volatility.
Mhm. Yeah, for sure, for sure. Yeah, that's really good. That's really good. Thank you for that assessment on uranium. You all uranium. And we're not here pumping it saying it's gonna go $300-400 a pound, but we still see the bullish thesis is still intact. I mean, you have all these reactors that are being built. China's still building a lot of reactors that need this uranium to feed the reactors and stuff.
That's
And
correct.
there's still a lot in the works. I mean, a lot of bills and laws being passed in favor of uranium and stuff. So yeah, there's a lot of still excitement, and I think that we could see the prices go higher. Um, so yeah, so Alan, anything else you want to share with the audience before we wrap up?
Yes, to conclude with how I'm positioning currently, we mentioned commodities with a view on supply situations. The other thing is I have tremendously reduced the amount of my positions, and I'm looking more at kind of special situations and hedges against potential damage in the economy. Oil is one thing, gas could be another thing. However, I'm a bit less optimistic about US gas than I'm about European gas. Maybe that's a topic for next time. And then we have companies that announced to split themselves up. DuPont is one case in the US. I found another from a different sector in Europe that has announced to split itself up into 4 pieces and into publicly traded pieces, ready to lift hidden values because markets don't like conglomerates. So there are more than enough opportunities to play this market. There are always opportunities in every market situation. One has to have a firm thesis, which is based on solid due diligence. And if you have a clean balance sheet with your companies, then you have de-risked your investments pretty much. And then it's a psychology game, stay calm, stomach volatility, and that's perfectly fine. However, what I would currently avoid are these, they are called consumer discretionaries. However, I think a better word is consumer cyclicals. Then we understand that these are also cyclical companies like many resource companies are. And I'm not willing to buy any of those dips, no matter whether a stock has fallen by 30%, 50%. I have even seen 3 quarters down. Estee Lauder, such a makeup company from the US, stock is down 75%. However, I'm far from turning bullish on it simply because they have high problems, many challenges to solve, and how much a stock has fallen is not an indicator whether it is a buy or not. This is how I want to close.
Mm-hmm. Got it. And I just wanted to add to that, just really quick. You had mentioned Walmart in our last
Mhm.
discussion, and Walmart definitely provides cheaper goods, and so
Good
people,
point. Yeah.
yeah, they're trying to save a buck or two, and as you can see, Walmart's still been moving up strong. They just had earnings. You had
Yeah.
that sell off here, and then they had earnings and just popped back up. So yeah, I mentioned Walmart last time, and you mentioned that you didn't have a strong conviction on it, but you knew that with people rotating out of these cyclical consumer cyclicals or discretionary stocks, and that Walmart would benefit, when economies get weaker. And so
yeah, where people can save money and nonetheless fulfill their everyday needs, these companies more likely than not will tend to be beneficiaries.
Yep, exactly. Well, all right, Alan, I appreciate you for coming on. Where can people find your website? I'll be sure to link to it, but where can people find you on X as well as your website?
Yeah, thanks, Daryl, for having me on. Either on Twitter X by my name or Financial Engineering. This is the name of my website, of my blog, where I'm writing about stocks and about my best stock ideas for my members also. And happy everyone's welcome, and I'm happy to be back at your program, Daryl, to have another discussion. Thanks for having me on.
Yes, indeed. Till next time.
Have a nice day.